In my last video, I told you that the US healthcare insurance sector was in trouble. And yesterday, UnitedHealth, the biggest and most dominant player in the space, reported earnings. And what we learned is simple. Even the giant is struggling. Rising medical costs, pressure from Medicare Advantage, and regulatory scrutiny. UNH is facing the exact same headwinds as everyone else. And Wall Street didn't like what it saw, causing the stock to drop over 7% after the report. But here's what makes it interesting. That doesn't mean it's a bad investment. Actually, the fact that even UnitedHealth is hurting tells us this is a sector-wide reset, not a company-specific collapse. So in this video, we're going to break down what UnitedHealth's results really mean, not just for this stock, but for the entire healthcare insurance industry. We'll look at UNH's earnings and what's driving the profit pressure. We'll briefly go through the company's financials and, of course, calculate the intrinsic value to see if it could be a good investment today. Let's get into it. On the surface, UnitedHealth's second quarter results were disappointing, and Wall Street made sure the stock price reflected that. So what actually happened? Let's look at the numbers. First of all, they reported $4.08 in adjusted earnings per share, which was around 10% lower than expected. On the other hand, they beat revenue expectations by around $100 million. So revenue was slightly better than expected, but profits took a hit. And the biggest reason for that was medical costs. The medical care ratio, a key metric for how much the company pays out in medical expenses relative to premiums collected, jumped from 85% last year to 89% this quarter. That means higher claims and thinner margins. And the pain isn't temporary. For the full year of 2025, UnitedHealth expects adjusted EPS of at least $16, while analysts expected it to be closer to $21. That's not a small drop. Revenue, on the other hand, is expected between $445 billion and $448, which is just slightly below consensus. So this lowered guidance, combined with the uncertainty in the Medicare Advantage sector, sent another wave of fear through investors. What's driving the cost rise? One major factor is the return of elective procedures, especially among seniors on Medicare Advantage plans. Think hip replacements, joint surgeries, and other care that was delayed during the pandemic. As patients flood back into the hospitals, insurers are left with the bill. But it is not just medical expenses causing the problems. This was also the company's first report under the new CEO, following the unexpected murder of the previous CEO Brian Thompson, a damaging cyber attack, and ongoing Department of Justice investigations into Medicare billing practices. It has been a year of heavy scrutiny and major leadership turnover. All of this has dragged the stock price down nearly 50% year to date. But while Wall Street is focused on the short-term chaos, long-term investors should be asking a different question. Is this pain already priced in? To understand that, let's do a quick financial analysis and check if there are any red flags in UnitedHealth. So UnitedHealth is currently trading at around $260, far off from its all-time high of over $600. Their current PE ratio is around 11, with a forward PE of around 12. On top of that, they have this great over 17% return on invested capital, showing that the company does a great job at investing their money. Their net debt to EBITDA ratio is 1.3, which is on the lower side, as we like it to be under 2.5. On top of that, their revenue is growing really consistently over the past 10 years, as it more than doubled, going from $184 billion to $400. Now looking at their net income, they're showing beautiful, steady growth. If we ignore this last year when it went down due to current issues, we can see that the company's net income more than tripled in the previous 9 years. On top of that, when we compare net income to free cash flow, we see that free cash flow always outperforms net income, which is a really nice thing to see and signals that we're looking at a well-run business financially. Now here's what analysts are predicting for the company. For revenue, even with current setbacks, analysts predict it to grow every year for the next 5 years. And as far as earnings per share go, we see the setback in the next couple years with a clear rebound in the few years after that. So from the financial standpoint, UnitedHealth still looks like a very well-run business. Debt levels are low, return on invested capital is strong, and the valuation multiple is far from from the standard one, especially after the recent sell-off. Revenue has been consistently growing, and net income growth has followed a steady trend aside from the current setback. And based on analyst expectations, a rebound is clearly in the works over the next few years. So from the fundamental standpoint, this isn't a broken business. It's simply under short-term pressure. So the next question is, what is it actually worth? To understand that, let's move into the intrinsic value calculation and see whether the current stock price leaves any margin of safety. In the last 12 months, UNH did $23.89 in EPS. And as you can see, with these highly pessimistic assumptions of no growth over the next 5 years and only 5% growth for the 5 years after that, with a terminal multiple of 15, if you would like to get 10% annualized return, you could pay $323 for the company today, and it's trading closer to $260. In fact, I just adjusted the numbers, and it seems like with these highly pessimistic assumptions, UNH could actually return around 13% over the next decade. So let's adjust my assumptions from pessimistic to conservative. And let's say that for the next 5 years, UnitedHealth's EPS will grow at 5%. And for the 5 years after that, they will start growing at 10%. Keep in mind that their normal rate is actually higher than 10%. So with these conservative assumptions for a 13% annual return over the next decade, you could pay $370 today. So I adjusted the terminal multiple again, and we can see that if these assumptions come true, we could get closer to 18% annualized return over the next decade. Alright, so where do we land after all of this? To me, it looks like a short-term storm, not a structural collapse. Yes, margins are getting squeezed right now, but that's part of the cycle. Healthcare insurers will reprice their plans, and over time, those elevated medical costs get passed on. That's how they restore profitability, and history has shown that UnitedHealth knows how to do it. Even when I ran the numbers using pessimistic assumptions, the stock still pointed to around 13% annual return over the next decade. And with my conservative outlook, we're talking about closer to 18% per year. That's the kind of upside you don't see often in a company this dominant and with this track record. Now, if you want to get a deeper picture into what's happening in the healthcare sector and to see which 2 stocks I personally bought during the sell-off, check out my previous video. You should be able to see it on the screen or in the description down below. If you enjoyed the video, drop a comment, click the subscribe and like buttons. And as always, guys, thank you for watching, and I hope to see you in the next one. Bye.